Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia. And the markets are just trying to get back into the green as we speak. Absolutely flat. I think this would be the third day that markets are consolidating. Last week was a big one, mega gains. And from Friday to today, markets are just pretty much sideways. The Nifty right now is at 24,945 mark. Unchanged compared to yesterday's closing level. The Sensex is down just by a smidge, 40 points lower. The sectors which are weak today include defense. So defense is down 1.5%. Autos and banks also underperforming. The Nifty Auto Index is down 0.5%. On the way up, you've got the CPSE stocks. So the Nifty CPSE Index is your best performing index. IT, realty, metals also giving it company on the way up. But all in all, things are quiet. Just trading absolutely flat now.
Well, the good part about the last 3 days has been that even if there is a dip that has come, it has not been alarming. And if there has been a dip, it has been bought into, and that is what has happened today as well. Be interesting to see whether it sustains or not as we go into the second half of the trading session. But the common factor of the last 3 sessions has been that the range on the Nifty has been extremely narrow. Even today, the range is around about 120 points, not more than that. The Nifty Bank too opened higher, has cooled off from those highs, and now is trying to recover from lower levels as we speak. So that 55,500 mark continues to remain a barrier for the index. It's still trading around those levels, and the broader markets too are taking a bit of a break after days of outperformance. After almost 6 to 7 days of outperforming, the mid-cap index is taking a bit of a breather today. Same at the flat line, but no significant outperformance as has been the case over the last few days. The small cap index too now taking a bit of a break in today's trading session, though in the green, but again, no significant outperformance. Of course, there are plenty of stock-specific moves as we speak. Newgen Software has now sprung to the highs of the day, now 11% higher on the stock, the top gainer on the Nifty 500, and there you can see the moves there on the on Newgen Software. Pfizer is the other one. Earnings reaction, dividend announcement. So all of them percolating into that 10% move that we have seen on Pfizer in today's session. On the downside, though, is defense and railways taking a break there as well. Cochin Shipyard is the top loser today within the broader market space, 6% lower in today's trading session. Some of the other railway names, be it RITES, Railtel, Ircon, Jupiter Wagons, all of them seeing losses of anywhere between 3 to 4% in today's trading session. But let's begin the show with a corporate conversation. Then Karur Vysya Bank has seen its net interest income and net profit surge in the fourth quarter of FY25. Their asset quality has also improved. The MD and CEO, Mr. B. Ramesh Babu, who's joining in now on the show to discuss the road ahead for the company. Mr. Babu, good morning. Thank you so much for joining in. The kind of year that you have had in FY25, now with the fact that you are heading in towards a lower interest rate environment as well, what are the kind of growth targets that you are penciling for FY26, be it loan growth, deposit growth and NIMs? If you could share all the 3 numbers with us, sir.
Yeah. Good morning, this year what has gone by is one of the picture perfect years, I can say, because what all we have planned we could do basically on 3 fronts. One is on the business growth, asset quality and profitability. So all these 3 boxes we have taken in full without compromising on any other parameter. Business growth at the cost of asset quality coming, it's of no use. So profitability also. So what we did and what we want to do is, so last 2 years back itself, when we understood saying that the interest rates will come down in due course, we started changing our business model. Earlier, our corporate used to be up to 40%. We have brought it down progressively to 40%, 14% of the book now. Now, 86% of the portfolio is retail now. And out of that, if you look at commercial, which comprises of up to 25 crore exposure, we brought it to 36%, which used to be around 28%. Here, the advantage for the bank is the entire product is granular, and above all, the margins are good there. And third thing is we are there in the field. So that is the reason we started engaging with these borrowers and all. We are able to move forward. So going forward, if you look at it, the last year we closed at 1.73 for the quarter with the ROA at 1.72. What you said is correct. There are many moving parts are there. We need to look at it. With the rates of interest which are going to come down already, 2 cuts are there, expected 2 more cuts. So that way 1% we must be mentally prepared. So our book is 52% is EBLR. There straight away we need to take a hit in that. So that is the reason what we thought. We have 3 levers are there. to support us. One is we started focusing on the other income. Other income has again two parts under that. One is the non-fund based business, what all is there. So there we have sufficient capital is there. There is no requirement for a deposit there. If the deposit is required, the costing, margins, all these things are there. When we are sufficiently capitalized, non-fund is a good area. And likewise, the recovery from the written off accounts, which used to be 30-40 crores per year. This year, we could recover around 600 crores. The same tempo we are going to continue that on the other income side. To some extent, we want to focus on the expenses side also, 10 to 15 basis points where we work on that. And above all, we have sufficiently provided for all the provisions, and prudential provision of 100 crore also has been made last year. ECL also has been made. So that way, wherever it is required, absolutely we have provided. Our SMA 30 book is lowest in the industry with 0.3%. So that way, the chances of slippages are relatively low. With all these things, what we thought is we can maintain a ROA of 1.55 to 1.65 by operating with all these levers. Of course, not losing a grip on the NIM as well as the net interest income also.
Okay, you've explained in great granular detail, Mr. Babu, all the different moving parts. So ROA is 1.55 to 1.65% and NIMs should contract. I believe you've given a guidance of 3.7 to 3.75% for net interest margin.
Yeah, Rima, that's what we have given it. Because what straight away, if you look at it, 1%, suppose the rate cut is there for any reason, 52% of the book is EBLR. So we thought 50%, 50 basis points, we need to get down from 4.05 NIM what we have, which we may be landing at 3.55. But many measures we are taking. With that, it can be 3.75. But this is a back of the envelope calculation. So the way last 2 to 3 years, all of you have seen. So how we are holding our margins. So I'm not saying that so we will be below that, and to the extent possible, what best we can do, we will do it for protecting the margins also, including NIM.
Okay. And what about the deposit and advances growth?
Yeah.
What are you penciling in terms of a growth rate for this FY26?
I agree. So earlier, we used to talk about advances growth. Now the point is advances growth is now linked to the deposit growth. Our retail engines, all of them are working so well. Our RAM vertical is doing so well. This year, we could grow by 20%. So the sustained momentum is difficult to stop. So that's why what we are doing, the pricing we are seeing, lower yielding advances we started getting out of that. So that way the momentum will continue. Corporate also, we may not be able to grow much because till such time the deposits proper mix comes up to us. So coming to the deposits, the bank was doing a traditional model for 2 years back. So 2 years back, first time in the 110 years, what we did is we have gone for an acquisition channel. So this acquisition channel, we have taken people from various banks who have the expertise in the liability acquisition, and we have created different sub-verticals under that. It can be for a corporate, institutional, NRI, salary package, and we have created products for that. So that started stabilizing that one. Likewise, within the branch channels to deepen the existing relationship. So we have created a channel there. These two should support us a lot. So that way, this year, if you look at it, 20% is the growth on the time deposit. But you cannot continuously grow at that rate because the cost will not support you. So we will be constrained with the deposit growth, 13% we can think of. So whereas advance is concerned, we can say that industry plus 2% will be able to go. But that much of issues are not there as far as advance is concerned for us. It will be just linked and constrained with deposits.
So 13% deposit growth, Mr. Babu, and around about 13 to 15% advances growth. What would be a fair assessment?
Oh, no. What I told is industry plus 2%. That's what
industry plus 2%. Okay, sure. So what about cost of funds, Mr. Babu? What have they been in FY25 for you at the end? When are you expecting them to peak? And what are your targets for FY26?
At the end of the year, it was 5.76. So we feel that maybe next 6 months. So we can start seeing the slowly coming down because we also have cut the rates on the time deposits last week. And in due course, we'll be doing further, but it will have a lag effect. So one thing, almost what we need to see, we have front-loaded the benefit of the rate hikes earlier. So now rate cuts are happening. 3-4 years back, what we have got, we will be sacrificing a part of that. So that way, after 6 months, the things will be normal. And then naturally, the cost of deposits will be stabilized over a period of time.
So your unsecured book is amongst the lowest in the industry. Is it? I think it's just about 2.2% of the overall book. Why have you been cautious on that? And do you still see stress in the unsecured market, or is it time to step on the pedal here?
Yeah, agreed. Ours is the only bank we have an arrangement with the Amazon BNPL program. So wherein end-to-end checkout financing, we have done that, and it's going on pretty well. When actually some sort of a stress on account of the elevated leverage in the household savings. So we thought it's the right time to be careful, but we are having a backing of FLDG also, 5% for that. So with all these things, what we felt is maybe for the time being, next 6 months or 3 months, let us lie low. Like with MFI also, we have started 2 years back, which constitutes 0.37% of the whole book. So now that also we are going slow because we have learned many lessons with a small portfolio, with many partners whom we have. We will be able to scale it up. Third thing is 80 lakh customers we have created the Amazon BNPL. Even if let us assume a curated lot is around 5 lakhs, 10 lakhs with the past experience, that offers us enough opportunities for giving various products to them. So all these are in reserve. But one thing we need to see, without going for such an unsecured, also we are able to manage our margins at 4+. So with once unsecured, normalcy restores and we get the confidence on that. So it will be another kicker for us for the NIMs.
All right, Mr. Babu, the street is liking what you're saying. The stock is at the highest point of the day. Thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of Karur Vysya Bank there. The stock at the day's high, expecting deposit growth of around 13% and advances growth to be 2% higher than the industry. Take a short break here on Trading Hour. Up next, Commodity Corner with Manisha Gupta. Welcome back. 24,900 is where the index continues to remain, trying to defend some levels on the downside. But shifting focus now to the commodity space, Manisha Gupta is now joining in. We are focusing on crude oil prices that are bubbling and not bubbling at the same time, Manisha.
Well, yes, contradicting fundamentals really. But, you know, crude for one is not really declining very sharp. And we seem to be holding around that $62, $65 a barrel mark for both of those varieties there. Well, there is uncertainty about what really is happening between US and Iran. We've seen 4 rounds of conversations already. And there are very strong statements coming in from both the parties. So you do not know whether or not there is an agreement coming through. Well, the US is demanding a complete halt of uranium enrichment from Iran. And we all know that that's not going to happen. So the conversation still continues with an expectation that this perhaps is going to take longer than earlier thought. The other is the US president's statement where he says that Russia and the other country, which is Ukraine, could perhaps be nearing to a ceasefire. Now, that's what's taken the premium slightly off the prices. The other thing is about Moody's downgrading the US credit sovereignty. We've seen some pressure come in because of that as well. And all of China data that came in yesterday has not been supportive. So whether it has been about factory activity, retail sales, or the consumer confidence numbers, the fixed income growth numbers, all of that has been slightly weaker than what the street was looking forward to, and that's weighing onto the markets as well. So barring US and Iran, there's really no factor which really seems to be supporting crude prices, except the fact that the OPEC report suggests that India continues to be the biggest grower in sense of demand going forward as well. Those are the numbers that OPEC has put forth, that 5.5 million barrels per day is what we saw India consume last year. This year it's 5.74, and next year would be almost 6 million barrels per day. So barring Indian growth in demand for crude oil, there's no other country really looking at these kind of numbers, and that perhaps could be the only support.
Thank you very much for that. BEL's FY26 guidance up for you on your screen, 15% revenue growth. I think there's an error in the EBITDA margin. It's a 27% EBITDA margin that the company is guiding for in the conference call. The order inflow guidance is at 27,000 crore plus with a capex of 1,000 crore. But the two key numbers, 15% top line growth, EBITDA margins of 27%. The stock is up close to about 1.25. But HEG is reacting to a weak set of Q4 numbers. In fact, the last time I checked, the stock is down 5%. Now, at the bottom line, the company has reported a loss of 73 crore versus a profit in the same quarter of last year. But remember, yesterday, the big news was that Japan's Resonac, it's a Japanese company, and they have halted graphite electrode production in China and Malaysia. That's why the stock was up nearly 8%. Today, it's corrected. It's down 5%. We have with us Manish Gulati, the Executive Director at HEG. Mr. Gulati, before we get chatting about the numbers, the FY26 outlook, first on Resonac, how much the fact that they've shut production in China and Malaysia, how will this impact the supply in absolute terms and even in percentage terms, the global supply?
You see, good morning. The Resonac news is about shutting down of the Malaysia plant of 30,000 tons, and they had a Chinese plant of 15,000 tons. So total, they're shutting down 45,000 ton capacity. They're coming down from 210,000 to 165,000. So that is one reduction. And if you're tracking us, if you're tracking this industry for the last 18 months, there have been another announcements of GrafTech coming down from 230,000 tons to 178,000 tons. And there's one more, Tokai, that's another Japanese company. So they're coming down from 96,000 tons to 72,000 tons. So we're putting all these three major players together. So we are talking about a reduction of more than 120,000 tons on a base of, let's say, 750,000 tons. So that means almost an 18.5% correction in capacity.
Okay. So the supply now is going to be 630,000? Is that correct? The global supply now?
That's right.
And what is the demand? Because these companies are shutting down on citing, say, weaker margin pressure. So clearly demand is also getting constrained. So if the supply is 630,000 tons, what is the expected demand in FY26? And therefore, will it have any impact on pricing?
For that, we can have a look at the capacity utilizations of our peer group. With last year, I think GrafTech was at 55 or 58, and I think this year they're talking about 62s. HEG has been in 80s. So you can maybe figure out that out of, let's say, 630, maybe the demand is close to 500, not more than that. So that's what we are looking at, that once this steel production starts to go up, the electrode demand is going to increase. But for now, this is the figure. And these capacity corrections have come because of the margin pressures and because their plants are smaller size, located in high-cost economies. Like if you just look at, let's say, a Resonac operating 4 plants, so the average is, let's say, a 40K plant, and GrafTech, let's say, average of 60K plant, and Tokai, let's say, an average of 25K plant. Now, if you compare to HEG, which has a 100,000 ton plant under one roof in India, of course, we are more cost competitive. So whenever such low times happen, the plants who have higher cost face difficulties.
Manish, good morning. Thank you for joining in. What are the kind of volumes that you have achieved in FY25? You had earlier mentioned that you were looking at somewhere close to 80,000 tons. What was the figure that you eventually managed to close out the year with? And what are the targets that you're penciling in for FY26?
See, for the FY25, which went by, we did close to 80%. So that's what we achieved. And going forward, I'm hoping we can improve it from 80 to 85.
So from 80,000 tons, you're trying to say that you've achieved around 80%, which means around 64,000 tons?
No, we achieved 80,000 tons, close to 80,000 tons out of a 100,000 ton capacity. And what I'm saying, going forward, we are trying to improve it.
Okay. And what were the realizations in the quarter gone by, and what are the kind of realizations you're expecting for the first 2 quarters of the financial year?
See, between Q4 and Q3, they were almost similar. Going forward, for this quarter, April to June, it'll again be similar because it takes a while to correct. But what we are hoping, and we are seeing the green shoots of it, is that later in the year, the prices should start inching up. So we are getting a feeling of that, and with these supply corrections taking place, I think prices should start to inch up. But because we don't make electrodes today for tomorrow, normally every company is already locked in for next 2-3 months. So price increase takes time to take effect. But we are hoping that towards the end of the year, there should be improvement in prices and thus our margins.
Towards the end of the calendar year or fiscal year?
Calendar year.
And what would be the extent, Manish, of the price increase?
Very difficult question to answer. These things has to stabilize and the market has to support. The steel production has to support. So, I mean, I'm talking about the peer group. They are talking about anywhere 15%, 20%, but we can't hazard a guess. I mean, that's everybody's wish, all the industry's wish, because as you can see, these plants are closing down just because the prices were not viable. Then they were not economical. So they have the less efficient ones have to close down. And whenever you want, I can clarify the loss when you started the conversation that it is because we have a big equity in our competitor Graftech to the extent of 10%, and it is just a mark-to-market loss. Operationally, this has been one of our best quarters, the Q4 we are talking about, with highest EBITDA margins.
So, sorry, just on that point about margins then, if there is no price increase, which you're hopeful about, but assuming there is no price increase, what could margins stand at? And if there is a price increase of, say, about 15-20%, then where would margins stand? Because in the past, you've spoken about 20 to 25% kind of EBITDA margins. Is that assuming a price increase or even without?
Even if you look at Q4 and you exclude the mark-to-market loss of Graftech investment, which we have taken, we are actually in that range of 20 to 24%. And if we have no price increase on an EBITDA level, we for the next half, let's say April to June, July to September, we hope to be in that range of 20% EBITDA margin.
Clubbing a few questions into one, Manish, because of paucity of time. When does your demerger eventually get complete? What are the timelines that you have set? One. Two is, what about the needle coke prices? Have they finally cooled off? You had mentioned that they have not changed for the last 3 quarters. If you could share your views on both.
That's right. So first question about the merger, I think it's gone for SEBI approval, which will probably take, let's say, another month or month and a half, and then it will go for NCLT approval, which might take 2 to 3 months. So probably we are looking at this thing getting into completion towards the end of calendar year or maybe early next year. And about the needle coke prices still continue to be stable because electrode prices are where they are. There's hardly any room for needle coke suppliers to increase prices because we are unable to do that. So far, they continue to be at the same level in April, May, June as well. And I hope they remain at the same level for next quarter also, so that we can get enough support to tide these difficult times.
Right. All right, Manish, thank you so much for sparing time joining us today. Wish you good luck for the rest of the year as well. The management of HEG, the stock on yesterday's reports was an outperformer. Today, trading lower by around 5% and is expecting the realizations to start inching higher during the course of the calendar year. The demerger also likely to be completed by the end of the calendar year. By the way, the index currently 50 points lower. The Sensex is down 200. Broader markets too taking a bit of a break. But what are the charts indicating now? You get market technicals with Apurva Sheth of Samco Securities on the other side and some trading ideas as well. Stay tuned.
Welcome back. IT is having a good day. Look at some of these mid-cap IT names. Nugent Software, 10% up now. It's crossed the 100-day moving average, 1258. Zensar has been a strong mover. It opened higher and still up close to about 6%. Hexaware has now inched up nearly about 4%. But in the frontline pack, it's Infosys which stands out with a near 1% move. Now, Nomura has written a note on it. For Nomura, Infosys is the top pick. Their target price 17.20, and they expect the company to clock in a growth of 2.6%. But the reason we're talking about this Nomura note on Infosys is because this is the first management speak since Q1 began, right? The last time we spoke to Infosys was during the press conference, which is middle to early of April, so about a month back. So this is what the CFO and IR, that's the investor relations head of Infosys, had to say. In terms of demand, the outlook varies across sectors. For financial services, it's likely to be steady. For auto, the tech budgets are seen lower. Even for industrial manufacturing, budgets are seen lower. Retail, communication, high-tech outlook is likely to be weak on account of tariff announcement. Energy, on the other hand, is seeing a very strong pipeline, both from existing and new clients. On margins, remember the company for the last maybe about 2.5 years, has this Project Maximus going on, which is to improve margins. So they're saying that will continue to yield results. So over the medium term, margins should improve. For FY26, reiterated their margin guidance of 20 to 22%. And then they spoke about generative AI, where they said that, broadly, generative AI will not be deflationary. Now, why do they say that? Because generative AI can get work done faster with fewer people. There will be cost savings. There will be productivity benefits, which companies are passing on. Infosys said that clients are asking for the productivity benefits to be shared because this is a competitive environment, so you pass it on. But generally now, because Gen AI is helping you do work, faster with fewer resources, does that mean tech budgets get crunched? They're saying no. Even if you save or, with generative AI, it will be deployed into other tech projects. So on the whole, tech spends are not seen deflationary on account of generative AI. So these were some of the key takeaways from the management about the current environment.
And it shows the kind of sentiment that is surrounding the IT stocks currently. Nomura has called it its top pick when it's only 10% upside that it is projecting. Of course, the stock is up 10% in the last 1 month. So you need to bear that in mind as well. So that's Infosys for you. Nomura's key takeaways from the CFO speaks that it just had. Well, some of the other movers, Chennai Petro has now surged to the highest point of the day, 7% higher on that stock. And this is despite crude oil prices not seeing a very substantial correction or anything of that sort. They continue to hover around that $65 to $66 a barrel mark. So Chennai Petro at the highest point of the day, and along with Chennai Petro, MRPL has also surged to the highest point of the day, 4.5% higher on that stock as well. Generally, these names move in tandem, and you can see both of these names have seen a intraday surge in the last few minutes. So good time to get in a quick chart check then from Apurva Sheth from Samco Securities. Apurva, good morning. Thank you for joining in. And the good part is that the Nifty downside is not appearing very visible because any potential downside is getting bought into. But the not so good part is that there is exhaustion at higher levels. You're not able to move past that 24,500, 550 mark. So what are the charts indicating now for the index? And couple that up with your stock recommendations as well for the morning.
Thank you for inviting me on the show. Good morning. So the charts are pure exhaustive. So it seems that the Nifty is facing resistance at the higher level. So 25,000 being a psychological mark is acting as a good resistance for the index. And apart from that, if you look at the top 750 stocks, so nearly 75% of the stocks were in the last 7 months have been trading in the negative. So there's still a lot of catch up to do for the mid cap and small cap. So the index would stay sideways, and the mid cap and small cap would see some catch up, and we'll see sectoral rotation happening. So on the stocks front, we have 2 picks which are again from the commodity space. So first pick is ONGC. It is forming an inverse head and shoulder pattern, and looks like it's ready to move higher along with its peers like MRPL and Chennai Petro. So we have a target of 265 and a stop loss of 246 on ONGC. And another is Coal India, which is also forming a double bottom pattern. And the stop loss for Coal India would be 400 with a target of 445.
Got that. Thank you very much for that. From technicals to fundamentals. So on the other side of the break, we'll connect with Anil Rego from Right Horizons PMS.
Welcome back. The index now slightly below the 24,900 mark as we speak, but there is no dearth of stock-specific action as we speak. Domes Industries is down 6%. That's an earnings reaction. Bajaj Holdings is down around 5.5%, but it is the railway names that are continuing to take a bit of a beating in today's session. Of course, after the kind of run-up that you've seen last week, it is only par for the course that there is some profit booking that comes in, and a lot of these railway names. We take this conversation forward with Anil Rego from Right Horizons PMS, who is joining in now. Mr. Rego, good morning. Thank you for joining in. The flavor of the last couple of weeks has been these two railway PSUs and defense PSUs. They were the flavor until the mid of last year as well, until this very, very sharp correction that took these stocks down at least 50-60% from their peaks, and now they are heading back towards their peaks. Where are you positioning yourselves within this basket? And if you have any specific picks from this, if you could share those as well.
Yes, so firstly, I like to avoid sharing, stock picks more from a internal, compliance thing that we have taken. But definitely, I think if you see over the last couple of months, you found defense, especially, right? It was, on everybody's lips before that, and even when I was on my walks, my neighbors would come back and talk about them. So it really had gone into some great momentum. And in that period, I also believe that stocks which didn't deserve to go up also went up, right? Both on the defense and the PSU side. Okay, and so a correction I think was imminent, and that's I think what happened. When the run up is so high, then I think you will find that also the correction also is deeper than what is normal. So so that sort of step things back. However, what is the view of the sectors, both the PSUs as well as the defense, especially? I think thanks to the Indo-Pak tensions between the two countries and what you would also call a war. Okay, you find that defense has also come back, into focus there. Definitely, I think both PSUs and say defense sectors have been down for a long period of time, and that long period of maybe even across a whole decade or more than that, right? So when you find certain sectors like these are down, you will find the cyclical nature of it also will bring them back at a certain point of time. So I think that is also there. One believes that when you find a correct a pullback from such a long correction, it lasts longer than what most people expect. So I believe that it will continue, but from here you have to be careful about which are the better of these stocks, because initially a lot of the junk also ran up. Now we have to come back and step back and as an investor start looking at what is the earnings growth, what is the order book, quarter on quarter, how some of these companies are doing, and then accordingly look at it. Yes, we may have at least one PSU stock, I mean, it's a defense stock, but again, we go for quality. I would think that you can search around and then maybe one of the best quality names that you can go back and get into investing rather than getting on the ones on the.
Mr. Rego, sorry to cut you in, because we need to ask you a few more questions here. But what about these tariff-related sectors, right, that have been on the edge because of tariffs, no tariffs, pharma being one of them? You still don't know the quantum of tariffs that would be imposed on pharma imports from the Trump administration. You don't know what is the kind of impact that it would have on the sector as a whole. And considering the fact that pharma in general is such a wide basket in itself, where do you prefer within the pharma space, or do you even like the sector as a whole?
Yeah, so one of the things that we were slightly cautious, on sectors which could have been impacted and export-oriented sectors as well, more from uncertainty that's coming forward. At the same time, our view was that we, at least personally as a fund, we didn't expect a very large negative coming out of, high tariffs, because our view was it was a little bit of a posturing to be able to get other countries to import more from the US. Okay, and I think that is one area that I thought, and you'll probably see that is the key reason for it. The second is, yes, there will be some tariff, but I think it cannot be too high because, and I would believe somewhere around 10% is where I would think it'll end up. Okay, for most countries, unless he's trying to negotiate for something better, right? So and because a very high tariff also has an impact on inflation for the US, and when it has an impact on inflation for the US, okay, it's again a counter impact for themselves. So my view is that I'm not as apprehensive as some of the others, but yes, pharma is slightly uncertain, and it's important for the US as well because the price of drugs can go up. But I think there will be some impact. Again, we have to look at it. How is it versus other countries, right? In itself, higher tariffs may not be a bad thing, but let's say if you go back and see with respect to China, how is it relative, or some of the other countries, is where it is. So while there is some concern and one needs to be watchful of it, I definitely think that some of it will settle down maybe within a quarter or so.
All right, Mr. Rego, thank you so much. Paucity of time, so we'll take this conversation forward on another occasion. Thank you so much for sparing time and joining us today. That was Anil Rego there on for Market Fundamentals. Take a short break. On the other side, with no relief on AGR dues, with the Supreme Court rejecting the pleas of telecom companies, we discuss the road ahead for Vodafone Idea with industry expert and former Bharti Airtel CEO Sanjay Kapoor on the other side. Stay tuned.
Welcome back. Vodafone Idea share price is down 3%. This is over and above the 8% fall that it had yesterday after the Supreme Court rejected Vodafone Idea and Bharti Airtel's plea seeking a waiver of interest and penalty on the adjusted gross revenue dues, AGR dues. The Supreme Court called the petitions shocking, misconceived. Now, the decision comes as a setback for Vodafone Idea, which is reeling under huge debt. The company had earlier cautioned the government that it won't survive beyond FY26 without relief. So the question is, what next? What's the road ahead for Vodafone Idea now? Telecom expert Sanjay Kapoor, who was also previously the CEO of Bharti Airtel, is now with us on the show. Sanjay, thank you very much for joining in. The Supreme Court has pushed the ball back in the government's court. The government owns 49% stake in Vodafone Idea. So what are the options that rest with the government now?
Arina, good morning to you and the viewers. Yes, the situation for VIL seems very precarious. And of course, getting back to government now, does government want to own VIL as majority shareholders and cross the hump of 50% ownership? I'm not too certain of that. Why would government want that? They already have a BSNL to nurture and take care of. So that seems a little unlikely. So what will the government do? Does government have more appetite to create some sort of a relief for them? We will all wait and watch. But one thing I must say, the government in the past has definitely made sincere efforts to keep alive the oligopoly, which is good for the customers and good for a market India's size. But I think what the government can do, and without causing relief only to VIL, because government has to create a level playing field for Jio and Airtel as well. Tomorrow, if they come within ask for similar relief, will the government be able to do it? Then will the government become over-invested in telecom? So I think the chances of government now stepping in and not offering a level playing field to the other operators and overly committing themselves to VIL also probably seems to be, the chances seem to be diminishing now. So the road looks really tough, and all of us will wait to see what unfurls from here from the government side.
So there are two options with the government. One is converting further dues into equity. That would mean making Vodafone Idea a PSU company. And the second is providing another relief package, but that would be for the industry. It cannot be specific to Vodafone Idea. And therefore, the government may not have the wherewithal to do it. Is that right, in terms of a summary?
Absolutely.
So both options from the government seem unrealistic.
Absolutely. Right now, I think government will be in a very tight spot if they exercise for the either.
Okay. So if left to market forces, there is no intervention from the government, banks are not touching Vodafone Idea, and investors have burnt their fingers even in the last FPO, both big investors and even the retail shareholders. So now left to market forces, what happens to Vodafone Idea?
Right now we can't see any private operator coming in. We don't see the appetite of their promoters to pump in overly too much money to keep them A, liquid, and B, more importantly, to make them competitive in the market. Whether we like it or not, telecom is a mark-to-market business where you need to fiercely compete with others in the market. Your offerings and customer experience needs to be equated with them, if not better than them, if you want to stay competitive. And I think the monies that are required to make that happen are humongous, and small reliefs and interim reliefs and sporadic reliefs cannot create competitiveness that you're looking for. That's on one side when I look at Vodafone in isolation. But when I look at Vodafone in relation to Airtel and Jio, who are fully funded, who already have an enviable network compared to a VIL when it comes to a mark-to-market position, and they've already garnered almost 80% of the market jointly. So where is the room for VIL, even if they get partially funded, to challenge the two market operators, leading market operators? So I think even if a Vodafone Idea was to linger on for a while, there'd be a distant third operator who will probably be gasping for breath more often than not. So I think truly a mark-to-market play or a competitive play seems out of bounds for now. It's only a survival. How long can they continue? Is 2026 a realistic figure? Will it be 2027, or will it happen earlier to say we are going to NCLT and we can't keep this company liquid anymore? So I think the news is definitely not encouraging for them, although I'm sure they are trying every possible resort to come out of this crisis. I wish them good luck, but odds really are against them.
So it seems like NCLT is the end game for Vodafone Idea. You don't know when it'll happen, but going by what Sanjay is saying.
What is a very interesting observation from the Supreme Court ruling as well from yesterday that Citi has also highlighted. Sanjay, good morning. Thank you for joining in. That was the observation that I was talking to you about, that the Supreme Court mentioned that if the government wants to help you, we are not coming in the way. And the fact that even Bharti followed suit with Vodafone Idea despite being in good financial health, saying that if there is relief, it should be non-discriminatory. Is this the likely outcome that both the companies and the government were hoping for, and that the government could now go ahead, provide the AGR dues and still be compliant with the Supreme Court verdict? And part two of my question is, if they can rework the AGR framework, if they need to provide the relief, or has that ship sailed long ago?
So, whatever they do, it'll be with a prospective effect. I don't think they can change rules with a retrospective effect, because if they tweak around too much with AGR, then probably VIL will gain and Airtel will gain. But what happens to Jio, who don't have a lot of dues? Will it not be discriminatory for them? So I think there are many challenges that the government will have to do it from a retrospective. So I think any changes, if at all, can be from a prospective effect, according to me.
Okay. This is not something we've discussed. But what if Vodafone Idea goes into NCLT by its own volition, or if it's forced? How do you then expect? Will it be sold as a sum of its parts? Do you think there would be a willing buyer to buy the company as a whole? Because India is still a large market and there are only two players. I mean, if we have to, conceive of this option playing out, what would your thoughts be?
I don't want to be sounding very pessimistic, but the fact is that today the two leading operators are nibbling into the market share of VIL irrespective. So when they grow on price, they're also growing on the market share gain that they have because of VIL. So why would they invest and buy such a company? So I don't see any one of those two going ahead and saying, let's merge this with us. And we've seen in the past that, you know, a VIL and Vodafone and a Idea merger did not click. Now the other option is, will operators in other parts of the world look at India? Well, that option was always available. You know, VIL, you think, has not knocked the doors of, operators all across and investors all across, whether minority or majority. I'm sure they would have been open to all. We've not seen anybody come. The American operators have been here, left India, went away. So I think everybody knows the position. Plus, you know, the world over now, the third operator and the fourth operator, because of the more frequent capital cycles, are becoming lesser competitive. Now, if you invest into a third operator, even if it's a large country like India, your odds are against you, you know, because the two large operators in the market have taken the pole positions. Now, how do you compete with them? So, I mean, will it be good money chasing bad money if they end up doing it? So, you know, we've not seen the traction so far. I don't rule it out completely. But again, the chances of any international operator coming and pumping money behind a third operator who's losing market share seems a little tricky to me.
I know, Sanjay, you don't want to sound very pessimistic, but isn't this almost delaying the inevitable of sorts? Because considering whatever you just mentioned, to summarize that, isn't it technically pointing to the NCLT being the end game for Vodafone Idea, considering banks not willing to touch it, investors not willing to come on board? So possibly that's the last possible recourse unless the government springs a surprise.
Well, that's a no-brainer. Everybody knows that's the end point. All we are trying to do is, we are saying, is there a way that an oligopoly remains for a large, economy like India, and the customers have more choices? And I think that's the, hope that all of us live with. And, we don't want Voda to go away or Voda Idea to go away. But at the end of the day, like I said, this is a business which requires a huge amount of financial resources, and especially with the technology and the longevity of technology shrinking, the capital cycles have become more frequent, and you might get a survival kit today. But what about the newer technologies that are looking into your face and might be a reality in a very short while? What about other enabling technologies like artificial intelligence and, all that is going to generate a better customer experience? How will you pump money into all that? So just to stay competitive, you require a lot of money. And I'm afraid somebody who's struggling for small amounts of money, where and how will he garner that? So I think the odds are against them. Like I said, we hope that oligopoly remains, but not too sure how long, and when they pull the plugs, only they know. We cannot step into their shoes and take that call.
Yeah, we've not even spoken about the scenario that what if 6G comes, right? And there are spectrum auctions and companies have to invest big money. Then, how are you going to get that money? But thank you, Sanjay. It's been a great conversation as always for joining in. Get into a break. On the other side, we'll get you more on the market. Stay tuned.
Welcome back. FY25 has been a weak year for private life insurers. Yash is joining in now to explain us just that. Yash.
Well, as you rightly pointed out, FY25 has been a weak year for private life insurance companies. In fact, the weakest year in the last 6 years. The new business premium for private life insurance companies, that grew by just about 9.8% in FY25. Now, if you take a look at the growth between FY20 to FY25, the growth in FY25 has been the lowest in the previous 6 years. The average new business premium growth between FY20 to FY25 is also 16.6%, which is much higher than what the industry grew in the current financial year, that is FY25. Now, it's not just the new business premium which witnessed a slow growth. The total annualized premium equivalent or APE growth in FY25 has also been lowest as compared to an average of the previous 5 years, that is FY20, 21, 22, 23, 24 and 25. Now, for private life insurance industry, the APE grew by about 10% as compared to the average growth between FY20 to FY25 of about 14%. This is APE. Now, the total APE, as I was mentioning, showed a slowdown because of the sluggishness in the retail business, which was again, saw the slowest growth in the last 6 years. The retail APE growth in FY25, that stood at just about 3.23%, which was much lower than the average growth in the last 5 years of 13.6%. Now, the important question: has growth bottomed for private life insurance companies? Let's look at what the management of these companies had to say after their fourth quarter earnings. HDFC Life Management said that their APE growth is expected to remain soft in the first half of FY26 as it would be more back-ended. Margins, according to them, are expected to remain range-bound. ICICI Prudential Life Insurance Management expects FY26 growth to outperform the industry average. SBI Life Management expects a 12% growth in APE, 14% growth in individual APE and VNB margins to be between 24 to 25%. Now, Axis Max Life Insurance expects a 16 to 17% growth in APE, around 22% growth in VNB and margins to be around 24 to 25%. Brokerage are also optimistic on FY26. 22 of the 34 brokerages which cover HDFC Life have a buy call, 7 have a hold call and none have a sell call. The consensus 12-month target price is about 814 rupees, a potential 10% upside. 34 brokerages have coverage on ICICI Prudential Life, 22 have a buy call, 10 have a hold call and 2 with a sell call. Again, the consensus 12-month target price is 671, a potential upside again of 10%. For Max Financial Services, a total of 20 brokerages have coverage, none with a sell call and about 19 with a buy call and 1 with a hold call. Finally, for SBI Life, a total of 36 brokerages have coverage, 33 have a buy call, 3 have a hold call and none with a sell call. The 12-month consensus target price on SBI Life is 1965, a potential upside of again 10%. Valuations for private life insurance companies have also bottomed. As far as the price to embedded value for HDFC Life is concerned, that has moved lower to 2 times for FY27 estimates from 4.8 times in FY21. For ICICI Prudential, it has moved from 2.1 times, from 2.1 times to 1.2 times. For Max Financial Services to 2.8 times to 1.4 times. And finally, SBI Life to 1.6 times from 2.3 times.
Thank you very much for that, Yash. Well, with that, it's curtains down on this entire show. Thank you very much for watching. Don't go anywhere. Halftime Report is up next.